All right. Good morning, everybody. Good morning, everybody, and happy Wednesday. Grab your wake-up juice. Today is January 17th, 2024. Ton of things going on this morning. We got a lot of data came in this morning. Some good, some bad, some head-scratching. Let's just start with the big ones. Retail sales just hit the tape about a half hour ago, up 5.6% year over year in the United States. Everybody was so worried, self-included, by the way. Everybody was worried. This mounting pile of consumer credit card debt. Remember last summer, we were saying, no, the Christmas season, it is going to be just horrendous. Look at this mountain of credit card debt, the return of student loan payments. Oh my God, all these people are going to have to do their Christmas shopping right as they run out of money, the cost of inflation exceeding the wage gains for the last few years, the standard of living dropping. They're in debt. The student loans are coming back. And retail sales are up 5.6% year over year. How does that math make sense? Well, folks, little preview. I've got a video coming out later today. We're going to have it published probably around noon Eastern time, all about buy now, pay later, BNPL loans. You're not going to want to miss that video. Pretty ugly stuff going on with buy now, pay later. And that was a big factor in this big beat in retail sales. Obviously, the credit card balances have grown. We've got over $1 trillion of credit card debt in the United States. Student loan payments, what's that? Nobody cares. Student loan payments came back, and 40% of borrowers just said, nah, not going to pay, not going to make my payments. Got an entire generation of people who just ain't paying their bills, folks. And so, of course, if you just say, I'm not going to pay my bills, I don't care how much debt I take on, then sure, those people are going to increase their holiday spending. So, of course, this big surge in retail sales, it's certainly not people earning more money that's driving that. It is all debt-fueled, and that debt has to go somewhere. Look for that video coming out later today on BNPL. So that's the retail numbers. That came out today. Alarming data out of China. Alarming, but not surprising. Data out of China yesterday. We got their GDP, but we also got some of their population statistics. And China's GDP was a slight miss, 5.2% year over year versus 5.3% expected. Those are the official government statistics, mind you, so take that with a grain of salt. But man, China's population, and again, official government statistics, so the real data on the ground is probably even worse than they'll admit. The population in China shrank by 2.75 million people in 2023. Almost 3 million people fewer in China right now. Now, 2022, you may recall, was the first year on record that China's population had shrank since the Great Famine. You know, Mao Zedong's great idea about, hey, let's order all the farmers to stop growing food and make steel. Oh, crap, we forgot to feed the people. Big surprise there. Well, last year was the first time since that China's population shrank. It only shrank by a few 100,000 last year. It was just barely registered. But that birth rate has been declining as China's population has been aging. And now it just hit overdrive in a big way because the birth rate has fallen even further. The rate of deaths has accelerated. Some people are chalking that up to COVID. COVID or no COVID, without people being born, your population is going to shrink over time. That's how that works. And it all comes back to the stupidity of the one-child policy and this massive gender imbalance that's going on in China, combined with the migration into cities where the cost of living is so expensive, people just can't afford to have kids. China has got a real reckoning coming with their population. Now, guys, I've been talking on this channel for a long time about China's real estate collapse. There are already somewhere around 65 million vacant apartments in China. All of these developers have already sold about another 20 million apartments that they haven't built yet. And the Chinese government is trying to figure out, how do we get these apartments built, because people took out mortgages to buy them and pay for them already, and their banking system is at risk. So you've already got 65 million vacant apartments. You're going to add 20 million more, and now you've got 2.75 million fewer people to live in them. It's not hard to see where the direction China's real estate market is heading. And it's not heading there. We're not talking single-digit % declines or slow growth. We are talking utter collapse of real estate values in China. I don't know what's going to collapse first, the value of these buildings or the buildings themselves. They're poorly built and they're obviously being neglected. So China's got a real reckoning coming, and this is going to hit every facet of their economy. I mean, consumer spending, if there's fewer consumers, they're going to consume less. Even if your per capita GDP starts rising, if your capitas are shrinking, then your total GDP is going to start shrinking too. So this is a real big deal going on in China. Oh, and they brought back their youth unemployment statistic, and in a shocking turn of events, it's way down. Last summer, they stopped reporting youth unemployment as it was approaching, 22, 23% in China. Well, this month they brought the statistic back, and magic, it's way down. All we had to do was change the way we count people, and, well, things are looking a lot better. Youth unemployment dropped to 14.9% in China. Also, as some very sharp eyes pointed out in the chats on this channel yesterday, the New York Empire State Manufacturing Index, that's an index put out by the New York Fed, negative 43.7. That came in yesterday. That is the second worst reading ever in the index, worse than the entirety of the global financial crisis, and only a little bit better than the absolute worst that we saw during the peak of COVID. Manufacturing in New York has taken a 2-month dive, and we're not just talking about a little one, guys. Anything below zero is in contraction. This is negative 43.7. Big collapse in new orders, big collapse in shipments. Lead times are shrinking. Hours worked are shrinking. I'm trying to figure out if it's, related to some one story. I've been digging around. I can't find anything specific, but manufacturing activity in New York just absolutely collapsed last week. That's a very big one, guys. And it falls in line with that 1.5 million full-time jobs that were lost. That data point that was hiding in the non-farm payrolls a few weeks ago, even though they're saying, yay, we added 216,000 jobs. Don't pay any attention to the revisions. Something's going on there in New York. The manufacturing is really slowing down. It's been negative for over a year now, and it keeps getting deeper negative. We've got mortgage applications on a more positive note today. Mortgage applications are up by 10.4%. People are loving those lower interest rates. That's 2 consecutive weeks of big gains in mortgage applications. So, there could be some buyers coming in off the sidelines here. We've done a lot of videos recently about inventory that's coming in off the sidelines in the months ahead, but we're starting to see the buyers coming in too. Mortgage apps up 10.4%. Applications to refinance up 11%. Mortgage interest rates are still over 6%. So who is refinancing in this environment right now? My gut tells me it's still people who are trying to use their homes as ATMs, cash out refis. So I'm not sure an 11% increase in applications to refinance a house is necessarily a good thing, but that is certainly the result of lower interest rates. We got import prices are down 3.2% in the U.S. That is 11 consecutive months of declines in export prices, down 3.2%. 11 consecutive months of declines in export prices in the U.S. and import prices were down 1.6%. Also, 11 consecutive months of declines in import prices. That almost sounds deflationary, doesn't it? 11 consecutive months of prices dropping. Now, I know everybody's going to say it in the comments, and I'll say it too. It is not resulting in lower prices on the shelves, at least not for most things. But it's hard to argue with 11 consecutive months of declines in exports and imports. We'll see what those numbers do to our GDP math when the Atlanta Fed comes out with their next estimate. But for now, why don't we shrink my big melon of a head and let's see what is going on in the markets this morning, because, well, there is a lot going on. Right now, the S&P 500 is down 0.56% or 26 points ahead of the opening bell. Took a big drop right around 8:30, right as those retail numbers came out and right as those export and import numbers came out. I'm guessing the strong retail numbers has the market a little bit worried about a maybe more aggressive Fed. If the retail sales are still doing really well, well, then it's hard to justify a rate cut, isn't it? Although I don't think rate cuts have anything to do with unemployment or inflation or retail sales. I think the rate cuts is all about bailing out the commercial real estate and the banking industry before it's too late. But we'll see if any of these data points actually affects the rate cuts, because the odds of a Fed rate cut in March have been ticking down. It's still a likelihood, but they're down around 60% now when they were up around 80% last week. So the market is starting to reprice expectations for that March rate cut. We have got the Dow is currently down 175 points or about 0.5% ahead of the opening bell also. And the NASDAQ is leading the way lower, down 0.78% this morning, or 132 points lower. Again, big drop down just as soon as those retail numbers came out. We've also got a U.S. dollar that is slightly stronger. Again, this morning, the Dixies made a little bit of a run these last couple of weeks at 103.53. That is up 18 basis points this morning. And let's see, what do we have in the bond market? We have got yields higher almost across the board, but not by all that much. Again, we've got this dislocation in the middle of the yield curve, though. The 30-year yield is only up 1 basis point, 4.315. The 10-year yield is up almost 4 basis points at 4.105. By the way, the 10-year has now rallied about 30 basis points since the start of the year. Keep an eye on that one. But check out the 2-year here, guys. Again, a big move in the 2-year, yielding 4.333. That is up 10.5 basis points this morning. So once again, a big move in the 2-year relative to the rest of the curve. We're seeing outsized moves in the 2. 1 month is at 5.394. That is just marginally negative, essentially unchanged. So interest rates are moving higher today. And guys, reverse repo watch. We got a drop of $20 billion yesterday. And for the first time, we've got a 5 handle on reverse repo, $583 billion left of that excess liquidity that was printed back in 2020 and 2021. Ground is getting closer. We are still above that red trend line, but we're hugging it on the way down, still on pace to run out of money in the reverse repo sometime mid-February to early March, down another $20 billion, especially after that big spike that we saw a few weeks ago. Looking over at the commodities board this morning, gold is not liking these higher rates and stronger dollar once again. February gold futures at 2021. That's down $9.15 this morning, about 0.5% lower for gold. Silver not doing so well either. We've lost the 23 handle. March silver futures trading at 22.82 this morning, down 27 cents or about 1.16%. Platinum's down 0.5%. Palladium's down 1.5%. And West Texas Intermediate crude, look at this one. March oil futures, $70.80, down $1.72 or 2.37%. That is all about that miss in China, the population decline, the decline in or the less than expected growth in GDP. Once again, people are worried about demand in the oil markets here. Oil, despite all the geopolitical tensions, oil just cannot catch a bid lately. And here's the retail sales numbers that we were talking about earlier. Retail sales in the United States increased 5.6% year on year in December of 2023, the biggest increase in 11 months. That's following a downwardly revised 4% rise in November. It's a very slight downward revision in November. I wouldn't worry too much about that one. But considering the full 2023 unadjusted retail sales increased by 3.2%. And there you can see, guys, retail sales, they were in decline earlier in the year in 2023, but they rose pretty steadily throughout the spring, summer, fall, and then a big jump, 5.6% higher for December. Guys, this is not organic growth. This is not economic prosperity. This chart, this 5.6% growth in retail sales, what you're seeing is this, America's credit card bill. Now, $1.029 billion. It has just done nothing but rise ever since the middle of 2021. Everybody was locked down. Everybody got stimmy payments. Everybody got the bigger child care tax credits. So we paid down credit card debt. And then as soon as we got a little taste of freedom, how nice of them to let us out from house arrest, everybody went out and started spending money. They started traveling. Taylor Swift, Beyonce, whatever you want to call it, Oppenheimer, Barbenheimer. Now we've got over $1 trillion in credit card debt. And on top of that, we've got this buy now, pay later phenomenon, tens of billions of dollars borrowed in buy now, pay later. Not going to want to miss that video about what's happening to that debt. It is gross. It's all the lessons we didn't learn from the GFC all over again. And we've got people who just don't care about student loan payments. I don't feel like I should have to pay for my student loan payments. I think that's somebody else's problem. So I'm just not going to pay it. Instead, I'm going to run up the credit card and buy a bunch of crap that I don't need that's going to be worthless in 2 years. There is an entire generation of people who are adopting this way of thinking right now. And I'm sure that's going to end well. I'm sure that's going to have just a completely soft landing. It's going to be great. You're going to love it. Moving on, China's population drops for a second year, raises long-term growth concerns. pretty sure they're going to be saying what growth pretty soon, because it's pretty hard to have economic growth when you have a population in decline. This one hit the tape just last night. China's population fell for the second consecutive year in 2023 as a plunging birth rate and a wave of COVID-19 deaths when strict lockdowns ended accelerated a downturn that will have profound long-term effects on the country's economic growth potential. The National Bureau of Statistics said the total number of people in China dropped by 2.75 million to 1.409 billion in 2023. That is a faster decline than in 2022, which was the first since 1961 during the Great Famine of the Mao Zedong era. Now, guys, take a look at this chart. This is in Bloomberg this morning. This is going all the way back to 1980. A lot going on here. First of all, the black line, that is the absolute change as measured in millions of China's population. You can see that just swung negative, down by about 2.75 million people. The purple line is the number of births per year, also in millions. And then the yellow line is the number of deaths per year, also in millions. And what you can see here is starting last year, the yellow line crossed above the pink line, purple line, whatever you want to call that. Well, the pink line continues to decline because there's just not enough ladies in China. And the ladies that there are in China don't really want to have kids. And so the birth rate is collapsing. And even as the birth rate is collapsing, the yellow line continues to rise because you have an aging population in China. Now, a lot of the articles about this is trying to chalk this all up to COVID. And I'm sure COVID played a role in this, but you have an aging population. People die in an aging population. And if you're not having enough births to keep pace with that, COVID or no COVID, your population is going to shrink. And this is only going to get worse, guys, because look at the trend here. Look at how the decline in births, it's steepening. It's not flattening. It's getting worse. So this black line is going to keep heading south. It's going to head south at a faster rate as the yellow line gets bigger and the pink line gets smaller. So again, when you pass this law that says everybody's only allowed to have one kid, and you do that right around the time that selective abortions and ultrasound technology hits your population, people end up doing terrible things to make sure they have a son. Next thing you know, you've got a 35 million gender imbalance in China, 35 million men who there's just no women to accompany them. So it's basically the entire population of the state of California, only single dudes. I'm sure that would be a wonderful place to live. Imagine that. Well, you're not going to have enough babies born in that environment, guys. So China's got a real problem. Fewer people means job shortages, or not job shortages, means worker shortages. It means fewer people consuming. If China wants to transition from a production to a consumer-driven economy, they're going to have a hard time doing that without consumers. Certainly, the real estate crisis is just going to be just blown wide open by this trend. It's bad enough you've got tens of millions of vacant apartments. Now you're going to have tens of millions of fewer people to live in them. The situation in China is not going to get better, guys. It's not going to get better. And, let's talk a little bit about China's economic situation here. China misses fourth quarter GDP estimates, resumes posting youth unemployment data. Yay, the youth unemployment data is back. How nice of them to bring that one back. China missed fourth quarter GDP estimates on Wednesday, while it resumed reporting the unemployment rate for young people. The National Bureau of Statistics said that excluding people still in school, the unemployment rate for young people aged 16 to 24 was just 14.9%. That's way down from 22%. Things have gotten so much better in China since they decided to stop reporting the data, and then everything got better when nobody was looking, and now they report it again. And whoa, it's way down. That's so awesome. Totally organic, legitimate statistics. Most China story ever. Meanwhile, the unemployment rate in cities in December was 5.1%. The Bureau had temporarily suspended the release of the younger age group's unemployment rate in the summer, citing the need to reassess calculation methods, especially because they were portraying a picture that they didn't want portrayed. That unemployment rate had previously climbed to records above 20%. China also reported fourth quarter GDP figures, which were slightly below expectations, bringing 2023 growth down to 5.2%. The market was expecting 5.3%. And I think that slight miss in China GDP is partially responsible for that big drop in oil prices today. Moving on, we have got this one. Check bad couple of days for Tesla here, guys. First things first, Tesla price cuts send European and Chinese auto stocks lower. The EV giant cut prices in Germany by more than $5,000 after trimming prices in China. So again, we're seeing this deflation in the EV space despite all the subsidies and all the investments and the Inflation Reduction Act, and everybody's going to be driving an EV. I can't wait. It's going to be so great. Why do the prices for these things keep falling then? Shares of European and Chinese automakers fell after Tesla continued to cut prices amid heightened global competition and uncertain demand in the EV market. In Germany, the U.S. electric car company slashed prices by 5,000 euros for two versions of its Model Y, according to its website. The performance model now costs German consumers about 55,990 euros, while the long-range model costs 49,990 euros. Tesla also cut the base Model Y price by 1,900 euros to 42,990. Let's see. Shares in Volkswagen were down 2.1% on this news. Stellantis dropped 1.1%. Renault was down 2%. Mercedes-Benz fell 1.7%. BMW was down 2.4%. Meanwhile, in China, Tesla cut the price of its entry-level Model 3 by 5.9% to 245,900 yuan. It's about $34,291. And they lowered the Model Y's starting price to about 258,900 yuan from 266,400 on Friday. So Tesla keeps cutting their prices all over the world. And, well, that's not the only bad news for Tesla. You might have caught this story yesterday. EVs in the cold, not such a good mix. Chicago area Tesla drivers stranded as charging stations not working in bitterly cold weather. Tesla drivers are struggling to charge their vehicles in the Chicago area as many charging stations are not working amid the freezing cold weather. At the charging station near 95th Street and Western Ave in the Evergreen Park area, many Tesla owners were stranded with dead batteries from the cold. Drivers said there were not enough working chargers at that location. Our batteries are so cold, it's taking longer to charge now, so it should take 45 minutes. It's taking 2 hours for one charger that we have, said Brandon Wellborn, a Tesla owner. So not only are they cutting the prices, but we're seeing this, guys. EVs just don't work very well in the cold. The batteries lose charge in the cold. The range is greatly reduced. So the demand that electric vehicles place on the grid is extremely high at a time when our power grid is at its most vulnerable. During the cold is also when our power grid struggles to keep the lights on. That's the same time when the EVs are increasing their load on the grid. This is just a horrible way to run a power grid and a transportation network, guys. EVs, you know me, I've been talking about it a lot on my channel. For some people, it makes sense. For people who live anywhere where it gets cold ever or where the power grid is not absolutely secure, they're a terrible idea. All of these subsidies that we're piling into EVs, they're all going to go up in smoke. Meanwhile, Tesla stock down 2.15% this morning, trading at $215.20. Tesla stock's down a little over 50% from its highs in 2021. Unlike the other Mag 7 stocks, it has failed to recapture 2021 highs. Moving on a little bit here, guys. This one was just terrible. The Empire State Manufacturing Index from yesterday. The New York Empire State Manufacturing Index plunged to negative 43.7 in January. Anything below zero is a decline, I would add. That's the lowest reading since May of 2020, signaling a sharp drop in manufacturing activity in New York State. It compares with a reading of negative 14.5 in December, which is by itself terrible. And the forecast was for only a negative 5. So this was a huge miss here. New orders shrank big, down negative 49.4 versus negative 11 expected. Shipments were down big, down negative 31.3 versus 6.4 expected. Sharp declines in unfilled orders. Those continued to shrink. Delivery times shortened because the factories just aren't that busy. Inventories edged lower. Employment edged lower. The average work week declined modestly. Meanwhile, the pace of input prices picked up somewhat. Despite all that terrible activity, the decline in orders, the decline in employment, the decline in shipments, and yet input prices went up slightly? That sounds almost stagflationary, doesn't it? And finally, optimism remains subdued, although firms expect conditions to improve over the next 6 months. So they're optimistic. I guess that's good. Now, here you can see this big negative 43.7 reading, but let's zoom out on this chart, guys. Let's look at a 25. Well, let's look at the max chart here. This goes all the way back to 2003 when they first started collecting the data. Now, here's the reading we just got, that negative 43.7 number. Here is the worst reading ever. Very briefly in COVID, it popped right back up. after all the stimmy started flying. But you'll notice this reading here, with the exception of COVID, even worse than the low seen during the global financial crisis. This slowdown in manufacturing activity in New York is worse than '08 and '09. And yet all we hear is soft landing, how the Fed nailed it, mission accomplished, inflation defeated. Well, New York Fed Manufacturing Index begs to differ. Also, mortgage activities. This was actually a very silver lining to this gray cloud this morning. Mortgage applications in the U.S. surged by 10.4% on the week ending January 12th. That's the most in 1 year, and extending a 9.9% jump that we got in the last week. So 2 consecutive weeks of nearly 10% increases in applications for a mortgage. So there are signs of life in the housing market here. It's only applications. It's not actual sales. Doesn't say anything about home price, but this is buyers coming in off the sidelines here, guys. 2 weeks in a row, pretty big drop. Now, that follows a drop of 10.7% that we saw the week after Christmas. I'm pretty sure that was just holiday seasonality in play here. But 2 consecutive weeks of near double-digit increases, that is a good sign for the housing market. And the refi index, applications to refinance a home loan in the United States jumped by 11% in the second week of the year, sustaining a fast pace of growth from the 19% surge in the earlier week. So applications to refi, those continue to rise, defying reason, in my opinion. Who is refining? The average mortgage in the U.S. is somewhere around 4% or lower. And yet right now we're talking mid sixes if you refi. So why would somebody refi out of a low interest loan into a higher interest loan unless they were trying to cash out equity from their house? And that's what I think these big refis are. So some people might look at this data and say, okay, it's trending up. This is a good indicator. But when you think about the average mortgages and what they'd refiing into, I'm not so sure this big surge in refis is really a good thing. I'm pretty sure this is cash-strapped homeowners using their houses as ATMs. And we've also got export prices down year over year in the U.S. They decreased by 3.2% in December. That's down from negative 5.2%. I should say that is better than the negative 5.2% that we saw in November. But look here, guys, 11 out of the last 12 months, we have had negative changes in export prices. So, I mean, this is deflation, at least in exports. Maybe final retail prices haven't seen this, but, 11 straight months, big drops in export prices in the United States. Now, this isn't total exports. This isn't actual prices, unit prices here. So 11 months in a row, and we got the same thing for import prices. Import prices year over year in the U.S. decreased to negative 1.6% in December from negative 1.4% in November. Again, 11 consecutive months of decreases in import prices. It's another one of those deflationary impulses, or at least disinflationary impulses, that is down the line. If the import prices, the export prices are falling, if the manufacturing PMIs are falling, we should start to see lower prices eventually, or at the very least, we should start to see these prices stop going up. And remember, guys, I mentioned after CPI came out last week that I think CPI sent a false inflationary signal, because more than half of the increase in CPI that we saw in that last inflation reading was due to rents, and rents are not rising anymore, at least not in most markets. Some markets in the Northeast and the Midwest are still seeing price increases, but the rest of the country, the rents are falling. So I think that CPI reading was giving us a false inflation signal last week. And I just want to say thank you very much to the inflation situation. Thank you, sir, for the super chat, support of the channel. He says Adam Taggart had a guy on within the last week. He claimed that a 1-year extension option for the BTFP can be exercised by the banks using the program. I haven't personally verified. I haven't heard of the 1-year extension option, TIS, but I can tell you Joe Brown also just did a video about this over at Heresy Financial. And the thing about the BTFP loans is that they are a term of 1 year on the loans. So even if the program goes away in March, a loan that was taken out on the last day will still be in place for the next year. So it's not, if the BTFP goes away in March, it's not like the banks need to suddenly pay all that money back. It just means they can no longer take out new loans. So you already have a 1-year extension built into the BTFP just by the 1-year term. Can they extend it? I'm sure they can, and they probably will, because there's nothing, as the saying goes, there's nothing more permanent than a temporary government program. So I'm sure we'll see something like a 1-year extension, even though the BTFP is no longer serving the purpose it was created for. Now it's just a free money printer for the banks because of the arbitrage opportunity. You can borrow money at 4.8% from the BTFP, and then you can turn around and deposit it right back at the Federal Reserve and get 5.4% interest on overnight reserves. So it's basically a free arbitrage for the banks instead of the rescue plan that it was intended as. Like every government bailout program, it ends up being taken advantage of. It mutates and it becomes this big messy thing that just ends up causing another problem somewhere else. Thank you very much, TIS. Appreciate the super chat and the support of the channel. I'll have to check out Adam Taggart's video on that subject. I hadn't caught that one yet. And thank you, Nashville Pasta Man, who says 100%, I'm not going to pay my student loans, mortgage forbearance, going to call Instacart, DoorDash, but I will pay my credit card debt. Yeah, right. Exactly, Nashville. I mean, I wonder how much of this doom spending, buy now, pay never phenomenon is really going on right now. I mean, we have set the example now. We've set the precedent that don't pay your bills, nothing bad happens, right? And, you know, look, I can sympathize with somebody who was lied to and told, just go get a degree in underwater basket weaving, as my buddy Chris would say over at Financial Prepper, and you'll be a millionaire and set for life. A whole generation was lied to. I get it, and they have a right to be pissed. But push comes to shove, you took out a loan, you promised to pay it back, you signed on the dotted line, somebody lent you money based on your word, you owe that money back. And if you're like, oh, I shouldn't have to pay it, the government should have to pay it, that money is coming from other people. You're saying somebody else should pay for my mistake, and that is straight up BS. And there is an entire generation, or should I say a half of an entire generation, 40% of people have still not made any student loan payments since they came back. 40%. There's a whole half of a generation is just not paying their bills, and yet they're taking out buy now, pay later loans that have no collateral. They're not even reported to the credit agencies. I'm sure all these loans are going to get paid in full. Yeah, absolutely. I'm not paying my student loans. I'm not paying my mortgage. My car's getting repoed. But sure, I'll pay my credit card. I'll pay my buy now, pay later loans. Sure. Check out that video coming out around lunchtime today, guys. And thank you very much, Nashville Pasta Man. I appreciate the super chat and the support of the channel, sir. You are a gentleman and a scholar. And I just want to say thank you, everybody, for having your coffee with the Melonheads this morning. Thank you for the super chats, guys, and thank you very much to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you guys today at 3 p.m. Eastern time for our weekly Zoom call and Patreon. I got a link down below to all that good stuff should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.